Welcome to Breaking Banks. Welcome to this very special edition of the Breaking Banks and Emerge Everywhere podcasts. I'm in the host seat. I'm your host, Brett King. Joining me is Jen Tescher from the Financial Health Network. Jen.
Hello.
Welcome back to the show, your show and my show together. It's quite a special occasion. We have visiting all the way from Old Blighty, the Lord Mayor of London himself. Lord Mayor, welcome to Chicago in this instance.
Thank you very much. It's wonderful to be here.
What brings you to Chicago?
Well, the Lord Mayor is the ambassador for UK financial and professional services, but also for London as a global financial centre. And that means that everybody who has a stake in London is a constituency that I care about. We have more international financial and professional services players in the UK, London in particular, than any other financial centre in the world. So I, as Lord Mayor, would end up spending probably 100 days a year travelling around the world to between 25 and 30 countries, probably to 60 cities, talking to in many cases, finance ministers, governors of central banks, very large asset owners, pension funds, sovereign wealth funds, perhaps some family offices, of course, the big banks and insurance companies and asset management companies. And we work very closely in conjunction with the Foreign Office and the Department of Business and Trade as well. So on this particular trip, I have been over in San Francisco. I'm here for a couple of days in Chicago and then going on to Toronto. So here, we have just had breakfast with the embassy and the Department of Business and Trade, catching up on a little bit of the local politics and some of the things that the government, the UK government, is doing in the Midwest, talking about the existing discussions that are going on trade. And also about what's happening locally from a political point of view. What is the attitude towards the UK? What's happening in the Fintech area? And what are the things that we should be thinking about in London as a global financial centre to be able to be more responsive to the big financial players over here.
Having spoken to your predecessors, Fintech has been a real success for London. In fact, in many ways, London preceded the US in terms of the success with the fintech market. We've all heard the stats of the extraordinary progress that London made as a fintech center, more employees in the fintech sector than the United States, either in New York or San Francisco. Very well done on that. But and we've spoken to your predecessors on that as well. But apart from fintech, what are the other emerging technology areas which London's really focused on investing in and providing an operating environment for?
Well, look, I think although it's tempting to think about fintech as a sort of an industry in its own right, the fact of it is, every industry needs to have technology at its core. So we need to encourage tech innovation across the board. And the UK has got 4 of the best 10 universities in the world, 7 of the best 20 universities in the world, which is pretty disproportionate. And we've always had a very entrepreneurial culture. So fostering that technology base is really important. So it's not just fintech, but it's also green tech and renewable tech, biotech, life sciences. These are all extraordinarily important areas and will be the industrial core of the UK economy in the 21st century. So encouraging those sectors to thrive, encouraging more people to join them, creating great jobs, and creating wealth in those areas is going to be key. And that goes actually to the core of one of the things that I'm trying to accomplish in the course of my mayoralty, which is to generate more investment from the UK system in those sorts of companies. Because successful as they have been, and they undoubtedly have, they have been pretty reliant on sophisticated overseas capital to help boost them once they've had their initial seed capital. the accelerator capital, the late Series A, Series B, Series D venture capital has tended to come from the most sophisticated players globally.
Mm. I mean, this is a problem for many markets. The US, that's one of the powerhouses, particularly for Silicon Valley, is access to funding. My home, I'm a joint UK and British and Australian citizen.
I wouldn't have guessed.
There you go. I resemble that comment. Yeah. My mum was a Brom, actually. She was from Birmingham, immigrated to Australia when she was 13. But looking at the Australian market and the UK market, obviously different markets, but they both suffer from this lack of institutional investment at a growth stage. It really, there is some early stage funding available, but once you get to, writing the big checks, there tends to be more reluctance from the pension funds and so forth. But we have specialist venture capital firms here in the US that manage, very large billion-dollar funds and so forth. In the VC community, household names like Andreessen Horowitz, et cetera. How do you build that culture of investment? UK is a fairly conservative market when it comes to investment traditionally.
Yeah, I think this is an absolutely key question. And just while you mentioned Australia, I was there 5 or 6 weeks ago.
I'm sorry.
No. I had the most fantastic trip. I was in Perth, Brisbane, Melbourne, and Sydney in 9 days, and I was blown away with what goes on there. I was there particularly actually to go and talk to the Aussie Supers,
right?
Because that is a great example of how a pension system can be mobilized to invest in core industries and core sectors at an accelerator phase. And of course, what the Aussie Supers have found is that they have almost outgrown, they've been so successful, they've almost outgrown the domestic market potential, just because they need some risk diversification. So they're looking internationally, which is one of the reasons why they're all setting up offices in London, because the UK is such an important international marketplace for fund management. But going back to your core question, we have faced some very interesting situations in the UK because of the transition that's been made around our pension system. When changes were made to effectively shut down the final salary schemes, the defined benefit pension system, you ended up without new funds coming into that pension system, and therefore it was in runoff. So you needed to match a set of guaranteed outcomes, guaranteed liabilities on those defined benefit pension liabilities with assets which delivered cash flows. And that inevitably led to sort of de-equitization of the DB pension system. So instead of gone from a 60-40 equity fixed income split, it went very, very heavily fixed income. And that worked okay. It worked okay because you were matching off liabilities. As interest rates came down, of course, and the discount rate that you used to apply to measure the present value of those future liabilities meant that a lot of those pension schemes went into deficit. So at points at which corporate sponsors were able to see that they could close out their risks and their exposures to those DB pensions, you saw the risks effectively being insured by specialist players like Legal & General, Phoenix, Rothsay, PIC. And that's been a process that's been a good one, but it doesn't really do what we're trying to do here, which is to put money into the private equity market or the VC market. But replacing the DB pensions, and that there's just under £2 trillion tied up in DB. We've got another 2 trillion in DC local authority pensions and self-invested pension plans. And it's those pots where you're trying to accumulate capital over a long period of time that lend themselves to investment in unlisted securities. You don't need to have listed securities. Of course, one always has to have a mind to liquidity, but ultimately it's not as though these are being in payout at this stage,
right,
or in drawdown. In many cases, these are going to be 25, 30 years before you need the retirement income. So there is an opportunity for us to deploy some of that money to help support this particular area of this growth economy. So I'm proposing a future growth fund of £50 billion. Now, £50 billion in the greater scheme of things doesn't sound like an enormous amount of money. Of course, in VC, that's quite a lot.
It's quite a bit.
But it's 1.25% of £4 trillion, which is what the pension pot is in the UK. But that, I think, would be a very strong statement of intent in the UK that we really wanted to make these companies grow and scale and stay in the UK. Because if they reach, valuation of $1 billion, and then they're encouraged by their overseas owners to go and list, then they will become $5 billion, $10 billion, $20 billion companies elsewhere. We need them to really stay in the UK, or at the very least have the option of doing so.
Right. Well, I have to point out the irony, given that we're sitting in Chicago, which has the most underfunded pensions in the nation. And we have paid the price for it. And it continues to be a massive challenge because the state constitution makes it almost impossible to renegotiate the terms of those pensions. So sometimes a more conservative approach might actually be a positive one in the long term from a fiscal stewardship perspective. But I'm curious, you talked about, wow, if we don't have the capital to keep these companies in London, they'll go elsewhere, they'll list elsewhere. How much of that fear, that concern has been elevated by Brexit and the other challenges that I would imagine fintechs and other technology companies face in being able to access the European market? Talk to me a little bit about that.
I think as far as the City of London is concerned, Brexit is very, very much in the rearview mirror.
It's a done deal. It's not like you can change it.
It's not going to change.
Right.
I think that the issue that was frustrating was that it was still being very much a political football. And that was preventing us from having sensible conversations with our friends in the EU about what is in our commercial, mutual best interest. So it was very important to try and get some resolution to the big sticking point of Northern Ireland. And the Windsor framework, which was agreed between the Prime Minister and Ursula von der Leyen, has changed significantly the tone of the conversation now. And so we're really delighted to see that although the Northern Ireland Protocol continues to require further push, and we should not underestimate the political issues that exist in Northern Ireland about trying to get the DUP to rejoin Stormont. The tone of the relationship between the EU and the UK has changed significantly. And so we're now having, I think, really very constructive conversations. And that's important. And to be fair, the relationship between our regulators and European regulators continued to be extremely professional throughout the political wrangling. But I wouldn't say that the problems that we're looking to face now are really Brexit-derived problems, but I would also be keen to say that the solutions that we're finding now are also not necessarily Brexit benefits. I think there are this process of de-equitization and risk aversion actually stems much more back to the global financial crisis of 2007-8. And that was when, of course, we changed the regulatory system in the UK and set up the PRA and the FCA. PRA to look at prudential oversight of markets and systemically important players, and the FCA to look at after customers and customer outcomes. And I think what we are now doing is we're looking at that whole situation. We're looking at it from the perspective of, is there actually some EU legislation, particularly in insurance capital, Solvency II, which needs to be changed to be more appropriate to the sort of asset mix and product mix that UK insurers have, and there are some changes.
I was actually gonna ask you about the insurance industry as another source of investment capital, given it's such a strong presence in the City of London.
Yeah, and so again, the insurance market is particularly as long-term savings organizations are, if you like, the ideal lenders to long-dated infrastructure loans. But that has been constrained by Solvency II because the capital ratios, capital weightings that people had to put against those by investing in effectively unlisted debt instruments. The distinction is really between whether an instrument is listed and unlisted.
I see.
So what we've been arguing for, and the changes that are going through on Solvency II now, will mean that some of those long-dated assets always have to be approved in terms of their risk component. We need to make sure that they're good quality assets, of course, but if they can be eligible assets for consideration in something called a matching adjustment fund, then it means that there'll be a lot of extra capital that will be released. Now, I think that's one of the issues that has been a sticking point, which is the regulator doesn't want capital to be released and sent back to shareholders. They'd be more comfortable, I think, with capital being released from its sort of technical provision if it's going to be redeployed. And so the expectation is that we could be freeing up about £100 billion. It could be
not an insignificant amount.
Not an insignificant amount, and important in stimulating infrastructure lending.
The property insurance market globally really came out of the 1666 Great Fire of London. The need for property insurance was stimulated by that. So London really is at the heart of this. Has there been any cadence change in respect to attracting talent into the city, or London more broadly after Brexit, or even just after the pandemic?
Yeah, I think one of the things that we in the City of London need to do a better job of is banging the drum about not just the financial purpose of the financial and professional services industry, but also the social purpose of it too. And I think we've seen a real transition over the last 15 to 20 years in that regard. But look, let's make no mistake about it. Every aspect of everybody's life revolves around the effective workings of a financial system. Whether it's getting credit, making payments, looking at savings, borrowing money to own a house, everything. Trade finance, everything involves credit, cash, payments, and insurance. So there is a really critical part to play in that. And of course, Fintech is a very good example of how we can get lots of people involved in doing exciting things that will be transforming the conventional provision of financial services. The disrupting effect of Fintech is immensely liberating, and it stimulates a lot of creativity. So we want to get as many young people coming and working in any aspect of financial services. The fact of it is, it's a fantastic way to understand how the world works. And if you get a good financial training and understand how to raise capital, how to hedge risks, it will equip you to do whatever you want to do in your life as you start your own business and what have you. So we need to do a lot more of that. And one of the things that I've been focusing on as Lord Mayor is looking at this really sort of painful divide that so many of our societies are finding between those who are well-educated, financially literate, digitally skilled, who have all the opportunities that are afforded by this burgeoning new set of industries, and those who don't. And that gap is getting ever wider. So last week, we held the first Mansion House Summit on numeracy, financial literacy, and financial inclusion. We brought together 250 people in a room, and lots more online, representing lots of different organizations, money and pension services, credit unions, a lot of not-for-profit businesses and charities, banks, insurers, government officials, administrators, educators, academics, to talk about all of this and look at some of the examples that have been put in place in other countries around the world who've been trying to deal with some of these same issues. And there is the answer lies in fintech. The answer lies with a digital platform that people can access, and those who would otherwise not be able to have bank accounts or be able to get credit should be able to find that they have the ability to transfer money and participate in the financial system. So that's a really important part of things.
We had Costa Peric on the show a few weeks ago. Costa runs Bill and Melinda Gates Foundation's sort of financial health, for the poor initiative. And he pointed out that we've newly included 1.4 billion people into the financial system since, was it like 2013, 2014?
Yeah.
Largely because of the effect of mobile money access and mobile wallets that are coming into play. So that's interesting. It would tend to speak to what you're talking about, the fact that the problem of financial literacy being a precursor to access to financial services in some respect has been solved with technology now rather than education. And presumably with the tools that we're getting, the sophistication of the handsets, AI inclusion, we should be able to have a pretty good self-managed environment.
We should
for this.
We should. I think some of the interesting statistics that have come out of the summit, for me at least, are that children start to form their views about money and financial things when they're age 6 or 7.
Mm-hmm.
We don't have any real education about how young people should think about money, finance at primary school. We don't start sort of thinking about that until they're sort of 12, 13 years old. And even then,
it's pretty tough to even get a bank account before you're 18.
Oh, yeah. So I think there is stuff that we need to do when we need to look at the curriculum and see whether or not there are things that we can do. Prime Minister in the UK at the moment is pushing that he wants mathematics to be a much more popular subject. He wants all young people to continue to study maths up to the age of 18.
They call it math here.
Yeah, okay.
But it's fine.
Yeah.
We call it maths in Australia too. We were joking about this beforehand.
Yes, we were. I was prepared to say maths.
No,
I've been practicing. It's interesting because in the United States, math is required pretty much all the way up through high school.
Having
the
said
end of high
that,
school.
I mean, you get to university, and if you're doing a maths-related, undergraduate study, you have to do a couple of units of algebra to catch up. Whereas I would say in the UK that's you come out of high school with some pretty solid algebra.
Look, I think that there are two aspects here. One is we want to train people in STEM subjects,
Mm-hmm,
to make sure that they can move swiftly into a tech-oriented business and be digitally very
because
competent.
every job in every industry is going to have a tech component moving forward.
It will. But there's a much more fundamental problem that we're trying to deal with in the UK, which is that 48% of adults in the UK have the numeracy level of a primary school child, sort of 9, 10, 11 years old. And it's very difficult to think about financial literacy, i.e. trying to help people understand about compounding power of interest, how they can compare different credit options, how they should think about savings, if they don't have a basic familiarity and comfort with numbers. And numeracy is really about just a comfort with numbers. It's not even really talking about math. But so, you know, the financial numeracy piece is definitely to do with confidence. Literacy is to do with education.
Right.
And then financial inclusion is often actually not necessarily directly connected to either of those. There are lots of people who are financially excluded who are very good at managing their money because they have to be.
Correct.
They've got
Absolutely.
very little money, but they're very good at budgeting. We've got, I think, about 10 million adults in the UK who have savings of less than £100. So many of those are very competent about the way that they manage getting through the week. But you know, they don't have access. Many of those don't have access to any form of credit.
Yeah. You know, it's interesting to think about the role that technology has played in numeracy. Technology, the calculator on my phone, all of the automatic, I don't actually have to understand or be comfortable. So I like this idea of making sure that as we're engaging our young people with technology more and more, that in a way we have to add back a little bit of the traditional old school piece so that, you know, out of sight, out of mind, right? If it's not something I actually have to do anymore, then I don't feel comfortable.
I mean, when we grew up as kids, though, we were told you couldn't use calculators and so forth. Now, you know, I'm not doing longhand, multiplication or something like that. You know, I'm using.
But you don't even have to calculate the tip anymore, right? Because up pops, you stick your card in, and up pops, here are the options. So even small things like that, and that's great on the one hand.
But I think I would always, I think the danger of people being reliant on their calculators or computers, telephones, is they don't know what the answer they should expect. So they could get it wrong by a factor of 10. So if you have a good numeracy, good basic sort of basic math, you will say, well, I will expect the answer to be around 3.5. So if your computer then tells you it's 3.66, you say, well, that's fine. But if you don't know what to answer and you press the wrong button and it says 36, you wouldn't say, you wouldn't say automatically, well, that's obviously wrong.
Right. Well, and listen, we've placed the same kind of trust in technology and computers for, you know, the answer to a simple math problem, in the same way that we've given, you know, we rely on social media now for all of our truth, and people don't exercise the judgment to decide whether that's something, whether the source of that information, right, is worth believing or not. So I think these things are connected.
Yeah, I mean, the thing that I always find reassuring about math is that there's a right answer and there's a wrong answer. Yeah, and it's not open to somebody's interpretation.
Well, we need more of this certainty today. I do want to get into AI and its implications for London more broadly and culturally, get your advice on that. But let's just take a quick break. And when we come back, let's jump into emergent AI. Great. You're listening to the mashup of Breaking Banks and Emerge Everywhere today with the Lord Mayor of London. We'll be right back after this break.
Welcome back to this mashup of Breaking Banks and Emerge Everywhere. I'm Jennifer Tescher. I'm here with Brett King and, of course, the Lord Mayor of London.
So we wanted to just talk about AI. There's a lot of conversation about regulation of AI at the moment here in the US. We just had this, the Future of Life Institute, Elon Musk and others writing this letter suggesting a pause on the development of next generation language learning models as an example. But part of your job is to sort of anticipate where things are going for London. How do you think AI is going to impact this investment cycle in green tech, fintech, talent, and even regulation in the UK?
Well, I think that's we used to say $1 million question. It's just $1 trillion question for sure. And I wouldn't begin to know the answer to that. What I would say though is that it's really important for global financial centers like London to think about, the direction of travel with things like AI, the use of blockchain in markets, big data, machine learning, cryptocurrencies, tokenization. And with that in mind, and again, the Lord Mayor of London is in post for just 1 year.
Yes.
So I can't trample all over my successor's turf.
Although there has been a couple of Lord Mayors that have had 2 terms
There've been
in the last 600 years.
Yes, but most recently during COVID, the Lord Mayor did a 2nd year. We have to go back to the 1850s before you saw that again. But we are doing a project in London, working with a lot of the big financial service companies and service providers to look at what the City of London, what we think the City of London needs to look like in 2030 and beyond. So we have a program to pull together a roadmap, effectively, looking at all of these issues, looking also at green and sustainable finance, at voluntary carbon markets, looking at what we were talking about earlier about the growth economy and how that should be funded through the pension system, and indeed pension system reform that's overdue in the UK, and also at financial inclusion and how we talk about it's an expression that we use in the UK called leveling up, which is how we try and make sure that the wealth that is created in the UK spread throughout all regions. And so we are working on that, as I say, with a bunch of very large financial service companies, not just UK ones, big US ones as well, to get a sense of what we want London to look like as a global financial center. And the reason that we're doing that is we then want in September to go to the 2 major parties around party conference time. So this is what the private sector feels is really important for London as a global financial center, as we look at what New York is doing, as we look at what Singapore is doing, we see Tokyo and Shanghai doing. And because to get these things right, particularly from a regulatory point of view, and the regulators are very much involved in this project too, you need to have a vision as to where you're trying to get to. The things like AI, you need to be really looking out deeply into the future and saying, well, what are the implications of this for how financial markets work? So I don't have the answers, but we will at least have we'll have framed some very interesting questions and some options by September. So
if you were a young person starting out in your career today, what advice would you give that young person in respect to this sort of disruptive future that we have coming with climate change and AI?
Yeah, I think, I'm a huge optimist. I'm a huge believer in ability of humankind to find solutions to problems. But we need to empower young people. We need to encourage them. We shouldn't terrify them about the enormity of the challenges. We should give them the confidence to go and tackle those. So, get a good education, work hard, respect people, trust people. We're going to come to solutions to these problems by working together. So we're not fans in the City of London putting up barriers. We're great fans of building bridges. And so we don't like anything that smacks of sort of protectionism. We love competition. We love working. We love partnerships. And I think that should underpin everything that we try and encourage our young people to do. Be broad-minded, be open, be ambitious.
Yeah, great way to finish today. Can I ask you just in conclusion, how do people find out more about what the Lord Mayor's office is doing, and how can we participate?
Sure. Well, there's a website that talks about all of the things that the City of London Corporation does. The Lord Mayor sort of sits as part of that, sort of sits on top of that. But there's a website around what the Lord Mayor does. There is a LinkedIn, which is always a good way of following what I'm doing on a regular basis. It's sort of pretty active. It may make you tired reading it, but it's fascinating. There are so many different components to the work of the Lord Mayor. What we've been talking about is the most important. We do have a local authority, the City of London, which is its own city-state that operates. And then the Lord Mayor has a role on the sort of the ceremonial side in the UK. So I'm looking forward on May the 6th to participating in the coronation.
Wonderful.
Absolutely amazing historical opportunity. So it sounds like you're having fun with the role.
I'm loving it.
Awesome. Well, Lord Mayor, thank you very much for joining us today. It's been an absolute pleasure, and all the best with your travels.
Yes,
Thank you very much.
thank you.
Lovely to be with you.
Thanks
for having me.
And that's a wrap. At this stage of the show, it's great we had the Lord Mayor on, but I have the opportunity to welcome a friend back on the show. Not only a friend, but a business partner. My co-founder at Movement, Alex Sion. He's now the managing director at Motive Partners. Alex, welcome back to Breaking Banks. It's been a while since you've been on the show, brother.
Yeah, absolutely, Brett. It's great to be back. Great to talk to you again.
Yeah. How is life in VC land compared with being on the other side in the startup seat?
No, it's very interesting to be in a private equity firm like Motive. So we're a stage agnostic fintech specialist VC that we build companies, we back companies, we buy companies in fintech space. And you can imagine after kind of post SVB and kind of what's happening with fintech valuations, that it's a very interesting time to be on the private equity side of the space. And kind of I've seen it full cycle, as you know, from starting it up at the dawn to working in big companies and now being on the private equity side. So it's been an interesting journey.
No, absolutely. I mean, we are entering this new phase, as you've said. Silicon Valley Bank, it has created some challenges. But, it's created challenges for the traditional industry as much as it has for the VC space, I think. I mean, there's the question now, and you see people like Jamie Dimon, engaging on this, is whether or not, this Silicon Valley Bank collapse is an earlier indication of some sort of a structural impairment issue in the US banking industry and indeed as a whole. And there is a fairly strong argument for the fact that if you look at what caused SVB's collapse, the speed of deposit removal was a very big element of that.
Fintech innovation. Causing the collapse. Absolutely. No, I think it's interesting. Like I when you look at SVB and what happened there, there's obviously the kind of the systemic banking thing, but also what's going to happen to the startup ecosystem, right? Because that was such an kind of a iconic company underpinning a lot of the growth strategies, right? And just how companies were built, right, in the startup world, particularly in fintech. So I do think that,
it's almost a point of pride, isn't it, for a startup to be represented by SVB, right? To get support from them. So.
Absolutely. Yeah. And I really do think that is going to be significant change, probably just as significant, if not more significant than the more systemic kind of problems, which I do think are kind of like more stabilized, or they can be over, the commercial real estate and stuff aside. But I do think the impact to the startup, how startups work and what the next chapter of innovation will look like in fintech and broadly is going to be a key story, right, coming out of SVB that has yet to evolve. But I think there are some predictions.
Right. I mean, one of the things, you've got the value of, now you're with a mainstream private equity firm, obviously, but you also spent some time with what would be considered a strategic in terms of City Ventures. Is there more of an opportunity for players like Citi and others looking to innovate to come in now off the back of this?
That's my big thesis. Like, I really do think that if you think about kind of, and you wrote about this recently, chapter 1 of fintech, who created it? And it was really fueled by traditional kind of entrepreneurial models, startup models that were kind of, fueled by traditional venture capital, right? And basically taking on the industry from the outside and driving a lot of change and reaction there. Then you had the corporate VCs, right? Sort of like get organized, the companies like Citi, Chase, you name it, just about everyone in the Fortune 1000 set up some sort of venture vehicle. But they were generally playing catch up, right? Enormous amounts of money, but playing catch up and follow on. But I do think with more the traditional startup model, a little bit on shaky ground and just the nature of where fintech it is. I think that my thesis is that the corporates are going to have an outsized influence on this next phase, right, of fintech, not only from a funding perspective, but from a monetization perspective, like how these companies exit. And then also just even from an idea perspective, where the next generation of ideas pop up from, maybe within companies versus outside.
Right, but we have two new waves of innovation potentially starting. Well, one is clearly the AI implications, and then secondary will be what we might refer to as Web3, from a metaverse and augmented reality perspective, with Apple launching their smart glasses this year, and so there, we've seen with the app ecosystem, we saw with the .com, created these massive bubbles. And so there is potential for two new, tech bubbles to emerge, particularly around AI. We see that happening right now. The number of AI companies launching, is pretty rapid. And, one of the founding team members of Facebook, Meta, Chamath Palihapitiya, and well known in the Valley, he came out the other day and he was saying that, it's going to be a very different cycle for VCs as well, in that, before you were looking for these companies with 20 to 30 staff to produce this minimal viable product. And, you're having to write a check, you get through the seed round, but then you're writing checks for $20 to $30 million for these MVPs. But now, but that's largely based on a function of how big the team is. And now with AI, if you can write good prompts and you've got good models, then it could be 4 or 5 people. So we could see smaller checks in the VC space, initially at least with the AI stuff.
I think that's right. And I think you're spot on in terms of all of those comments. The bubbles themselves and the AI as well as Web3 are potential, and those are ones that are actually, because of the way their regulation sort of angle is going to make it hard, right, for the fintechs for the traditional incumbents to lead in those spaces. So that's an area, AI in particular, that Motive is very interested in. And to your point on efficiencies, absolutely, that's a game-changing technology, right? But as there's companies out there like Casisto, right, the folks that we know well, that first era of just natural language processing and optimizing search that is already kind of deep within banks. So this evolution, my hope is it can happen pretty rapidly, right? Because in some ways the UXs are already there, right? Whereas before, when you and I were starting Movin and some of the others, you had a paradigm change in UX. But if you're kind of just adding on and just essentially making chat smarter, making the phone calls smarter, making humans behind those things smarter, then you don't have as much of the kind of experience disruption, right? As you would, which I think makes it a really, really interesting space. AI.
Right, it's more plumbing, process automation and. But I think there's a strong argument that things like chat or human level support, that's becoming viewed as a design problem as well, right? In that, if you listen to the likes of WeBank, in Shenzhen and others, they talk about, if you need to speak to a human, we failed from a design perspective, right? And we now have the gap to have we could closing the gap on human-like experiences with AI. That's going to close pretty quickly.
No, absolutely.
And it's
absolutely.
not just in financial services, of course. It's going to happen in in healthcare, in particular. Your advice from a doctor will be AI augmented and things like that.
In the wealth space, wealth management. Absolutely, Brent, man. And I think this is another one where if I think about fintech and this next generation with corporates, some of this mentality, the way you and I are talking and envisioning kind of the world of the future, when we started out moving a long time ago, it was kind of pushing uphill, right, to get people to understand some of these concepts. But I do think that the cultural change now, right, within large financial institutions, if I had to say anything, the biggest success of chapter 1 was getting people to understand that this is happening, right?
Yeah.
Like this is happening, and that and understanding more easily the applications of technologies. Maybe not being able to move as fast as they'd like, but I don't think at any of the large institutions out, you're going to get the same cynicism, right?
Well,
and just outright rejection.
No, I mean, I think that's, as you say, it's, we've done the education. The disruption is fairly clear. All of the fastest growing financial institutions in the world tend to be these technology-led companies, right?
Yeah.
In fact, I don't know of an exception to that. So you got Nubank, WeBank, Stripe, et cetera, right? So, it's an interesting time. Banks. Sorry, go ahead.
No, to that point, like, you have these fast growth companies coming from the outside in that traditional model. To me, the opportunity is capital, right? Like, if you think about the capital that was coming from VCs and the models that they were pushing, right? Growth at any cost, unicorn based, that kind of thing, where corporates can be more methodical and more kind of well thought and more long-term in their thinking. I think in some ways the environment favors that. So no, it's no longer about multiple, right? There was a time when fintech was all about multiple growth multiples. Now it's about really the vision, right? What is the underlying premise of the technology and the transformation that is the story and is the business model behind it. That's a different kind of investor. That's a different kind of growth strategy to what you were saying. That's a different kind of way to build, right, a company. So you're maybe not going direct to consumer, but focusing much more on enterprise and partnerships kind of out of the gate. So there's a lot of things that I think change because of this shift that we're in, but it's going to be really interesting.
Now, you coming out of Citi Ventures and having seen Citi go through very significant changes in terms of their business model, over the last couple of years. You also have a bunch of banks in the States that are getting consolidated now. If we look at this as a trend, I mean, the number of banks in the US is roughly half what it was, 15 years ago. So consolidation is occurring very aggressively in the United States. But we've seen, because of the pandemic, and of course this was a trend before the pandemic, just accelerated by the pandemic, particularly for retail, all of the account opening is shifting to digital now. So, you've got so many of these community banks reliant on branches for revenue and things like that. There would appear to be some, the risk management side, we're now seeing that the technology players, this is a surprise conclusion, right? That the technology players are actually better on many instances at managing risks than the traditional players, right? Which the argument always was from the incumbents that while the fintechs might be able to do this sexy CX stuff, they'll never be as good at risk management as we are. And the analysis, if you look at Nubank, you look at WeBank, you look at Alipay, they are better than industry performance in terms of non-performing loans ratio and fraud and things like this. So it sort of seems like structurally that the banking model, with SVB and these elements, is the fundamentals of banking are being attacked sort of across the board. What does this mean for the structure of the sector moving forward? Do you think?
I think so. On a broad level, I think one of the bigger trends is community banks are waking up, right? They are kind of like aggressively now moving into digitization and adopting and investing.
10 years late, but
exactly. And investing, but they're getting there. And it's always that human connection at the end of the day of how do you kind of establish that relationship that is always going to be kind of the holy grail for everybody. To your other point on essentially risk management, I agree with you. I think but this also impacts startups as well as incumbents. Everybody knows now that you can't ignore like growth at all costs without focusing on risk fundamentally, and being able to control scale in a responsible way is the key. And they're both technology driven, right? Growth is technology driven, and risk management can be transformed by technology. The firms that get that right and are investing in both are poised to win, right? And I will push on one thing you said. Like, I do think, yeah, the fintechs that have gotten that right, absolutely, right? But the incumbents that really have the ability to break down the walls and kind of get into the heart of the organization and change the way they approach risk, they know the game too, right? So if they can really transform themselves digitally, there could be some really powerful plays out of that.
But let's talk about that. I mean, you've seen both sides of this. Well, you not only did you work as head of mobile for Chase after you left Movin, but you also then went into the venture side on strategics, and now in the industry side. But having said that, one of the things that you faced as an issue was the roadmap cycles for the big players. Tends to be 1 to 2 years out, whereas fintechs are a lot more agile, right? So there's still that sort of fundamental cultural shift. Are you seeing a cultural change there, do you think?
Yeah, I think in the next wave of corporate innovation, there's so much emphasis. It's no longer about the what and why, it is about the how. Right. So I think the ideas, the ability to generate and validate innovative ideas, people got that down and they come up with great ideas. But that execution model, right? How do you actually go about getting something to market? That's where structural change is needed. And I think the good news is that there's a lot. This is where partnerships come in. So I do think banks are more willing now, whereas before it was a build-centric culture. Now this idea of partnering to get agility, right? And creative ways of partnering, not just kind of like pay a vendor, but co-invest, co-develop, kind of joint venture, a lot more creative opportunities there and ways to finance and structure those things, to be honest. So I do think that I see that, right? I see banks pursuing partnership models in very creative ways to solve those agility problems.
And internally, what sort of org chart changes does that require? Because previously, when Movin when it started going out to banks like TD and so forth, we had a business sponsor, but essentially it was procurement that managed the process, and that was in itself problematic because they were very legally focused. But is that sort of changing now structurally within these banks in terms of partnerships?
Absolutely. So what I see is an evolution from more centralized innovation teams to more kind of decentralized, embedded into business innovation teams, and a contemplation of these, what I would call as separate pathways, whether you think of them as venture studios or partnership pathways, but these creative lanes of execution, again, falling, being overemphasized versus build strategies. So I do think structurally what that means is you got it's no longer the realm of that ideation and sort of let's explore broadly. It's more let's lock in on high potential areas and then really figure out ways in which we can invest and creatively execute, in more of a serious way versus a more exploratory way.
Again, culturally, you see these fintechs like Revolut and others that will try launching a feature, then they'll pull it back, because it didn't work and things like that. That level of experimentation in the fintech side is one of the strengths. And then the other element is, you talked about CX, UX stuff. I mean, that is a core capability for fintechs, whereas in most cases, even with the likes of the very large banks in the US, they're still outsourcing design to agencies and stuff, right?
Yes.
Or is that coming a bit internally?
I think it's coming a bit internally. There's been a lot of progress on that at the large banks that I've seen. Again, but the sensibility as well as the skill set building in that area has gone a long way. The one thing that you mentioned, the sandbox, the ability to test in a sandbox, that's still a tough thing to do. Right. And I think there are, again, but this is where partnership models come in and the more openness to being able to think about creative ways. So it's a problem that you recognize, like you can't really move as fast as Revolut if you can't get to customers, if it takes a month or two to get any new idea approved. So that is definitely a problem to be solved. But I think there's there's again more of a recognition of the problem and sort of creative lanes to solve it now. So I'm also optimistic about that for some of the larger institutions. But it still takes leadership. At the end of the day, you got to be committed to winning. And I think the also good thing is that now that the spaces where there's threat are more clear, versus before you were kind of investing like bet the table because we don't know where it's coming from. Now that they know, right, you can double down, right, if you're a big company, and you can really commit.
So what are some of those specific areas that you think are being doubled down on?
Yeah, so I think there's a motive is organized around sort of eight big theses, which are sort of those areas. So like wealth management, private markets, marketplaces in general, digital assets, democratization of finance. There's a couple of big themes that I do think kind of no bank is not going to have those things on their roadmap. Right. And if it's on their roadmap, you can be assured that they have the capital, right? This is where it comes down to who's got the most money and who can mobilize it fast enough. So if you can imagine the banks kind of know what they're betting on, and they now know how to build back and buy things in a better way. It's like I said, it's before in the fintech phase one, they were just figuring out what they were doing. But now that they do, and now that there's defined spaces and set priorities, it could be very interesting.
So if you're a smaller bank, globally, under 100 billion of assets, you're in the US as a community bank, you're reliant on your core system provider in many ways. How do you break out of that cycle to really do these types of innovations and partner with, fintechs to do more exciting stuff?
Yeah, I think that in and of itself is an area of innovation, right? Right. So there will be like how community banks find that third lane. The optimistic part is that because of advances in open banking and even some of the large incumbent platforms, FIS, Fiserv, and the like, make it easier, right? There's the ability to consume third-party solutions is a lot easier now. And like I said, you've got Alloy and Bank Tech Ventures and a couple of the folks that are really trying to mobilize that community banking segment in the US to be able to invest, right, in innovation and nurture companies. So I do think there's a lot of attention there, but you're right on the problem, right? Is that they've got to find a way to kind of move faster.
So I want to ask you a bit of a question from left field here now.
Sure.
I mean, we went through the hard yards with moving in those early days. It was incredibly satisfying in terms of breaking ground and so forth, but it was also pretty tough. We've seen a lot of people come out of the VC private equity space and do their own startups. Would you ever go into a startup again yourself?
I have my hats off to every entrepreneur and startup founder. It is the most rewarding thing, the hardest thing, and the thing that you will learn the most from in your life, as Brett, you and I both know. The quick answer to your question is I get to live the best of both worlds now, right? I get to support entrepreneurs on a broad scale and help them succeed, and to kind of use the things I've learned now to kind of help them with the pattern recognition and the kind of channels to succeed. I guess that's a good argument, Brett, for us. We should start another company.
Maybe. Yeah. But I mean, so what advice would you give to an entrepreneur trying to start in the space today?
From a fintech perspective, I think, like I said, my big thing is that strategics are not dangerous. So I would say, like, out of the gate, you need to think about models that work with banks versus that take them down. And that idea, I think
that's the general trend. Yeah,
exactly.
But I mean, like you talked about the fact that you're not vendors anymore; they're partnerships. I mean, is that culture emerging within the banking sector now?
I think it's not a bad idea. If you're an entrepreneur with an idea, maybe your first phone call needs to be to a bank, right? And say, can you co-invest? Can you build this with me? Right? I've got this idea. I think that's a play that wasn't there when you and I were kind of starting out.
Yeah.
Right. You had to kind of go to the traditional Silicon Valley investors, but I do think that's if I do it all over again, I do it now. Yeah, I do it that way.
It might take you a bit longer to secure the funds, though, right? Because
Yeah,
the
no.
strategics,
Yeah, exactly.
their process of approvals and stuff.
Yeah.
So we unfortunately we run out of time. Always great to catch up with you, bro. We're overdue for a sit down as well. But
Definitely next time you're in the city.
Yeah, how do people find out more about what you're doing and what's happening at Motive?
Oh, you can go to the motivepartners.com website and kind of check out what we're about. And I also wrote recently a white paper on kind of corporate innovation 2.0, which if you either ping me on LinkedIn or something like that, I'm happy to send to anyone who's interested. But it kind of shows about the predictions of where fintech and fintech investing is going to go, and with a focus on corporates.
Awesome. Well, Alex Sion, Managing Director at Motive Partners and co-founder of the world's first mobile neobank movement.
Awesome.
Thank you for being on the show today.
Okay, thanks, Brett. It's great to be here.
And that's it for the show today. If you enjoyed the show, make sure you tweet it out. Give us a status update on it. Also, if you can give us a 5-star rating, and it all helps people find the content over time. Of course, my thanks go out to the team at Provoke for the production, Liz Perseverance, Kevin Hersham on the production side, and Sylvie and Carlo on the social media side as well. But that's it for Breaking Banks this week. We will be back for another episode next week as we get closer and closer to our 10th anniversary show. Stay tuned for more Breaking Banks. That's it for this week. If you like the show, make sure to give us a 5-star rating on your favorite podcast platform, or share it with a friend, or share it on social media.
We'll see you again next week with more Breaking Banks.